Welcome back, traders and investors. We have a special guest on the line, Scott Hunsader, founder and CEO of Nanex. Eric, how you doing this morning?
I'm good, thank you.
Just briefly, could you just tell us how you got interested in this part of the markets and developing Nanex?
I started in '86. I was collecting everything trading on the CME on a floppy disk and selling it on a bulletin board system. And I've been working with market data ever since.
So Eric, obviously you see lots of data there at Nanex here. What's you were talking this morning that you were seeing some crazy examples of how the market is potentially rigged. What were the examples you were talking about?
Well, you see, when we get actual trade executions, then we know who is behind some of the orders in the marketplace. Otherwise, the only one who knows the who is the regulator, and that's even questionable. But when we have a who, then it allows us to see a lot more of what's happening. And in this particular example, it was in a very large cap stock, heavily traded, highly liquid, and we were seeing fully half of the liquidity disappear. We're talking like 10, 12,000 shares disappear in milliseconds as soon as this order shows up.
What stock was that on, and when was this?
It was Ford.
And when was this?
Just Friday.
So what exactly happened?
Somebody's trying to buy 20,000 at the marketable limit order, and the aggregate amount showing is quite a bit more than 20,000, and they end up getting quite a bit less than the 20,000. And what's even more egregious is that there are others who are getting some of those trades.
So you're talking that somebody came and tried to lift the offer, and for 20,000 shares, they didn't get the 20, and then the stock started moving out ahead of that?
Just, by a tick. So it's just Ford takes a lot to really push forward. But if 20,000's on the offer side, in some cases, they were only getting 12,000 of it.
Was this something like what IEX had talked about, and going back to the whole Flash Boys, where, and do you think that still is happening, like where you've got an offer on?
Absolutely. That's what this is. Yeah, no question about it. I mean, the market is dead quiet until this order shows up, and it's the only thing stirring things up. And it's not just one example. I've had several examples. And you can see within a millisecond, on all the other exchanges, the liquidity just disappears.
Eric, what's the process you're going through here? Are you looking at what happened on the IEX and then looking at the other exchanges, or vice versa? You saw the stocks move on the other exchanges, and then the order comes into the IEX.
I'm just looking at top of book, consolidated, the total size at each exchange during the event. So these events are like 15 milliseconds long. And in the first few milliseconds, half of liquidity just disappears.
Just to give you a little bit of background for those who didn't read Flash Boys, the whole argument made from Michael Lewis and obviously from IEX is that when you go to try to, if you're a big institutional trader, and let's say there's 100,000 shares on the offer, and you go to try to lift 100,000, well, it's broken up on different exchanges. And what they were arguing in the book is that when you send the order and try to take it from all 12 exchanges, the orders don't get to each exchange at the exact same time. So when they get to the first exchange, if you were the same trader and you were offering on the other 11 exchanges, once you get executed on your first order, you quickly cancel the other 11 orders and get out of the way because there's real liquidity coming in. And that was the argument that was made in the book. So you think that argument is true then, Eric? And did I explain it okay?
Yeah, I will publish this sometime this week. It is absolutely. Irrefutable evidence right here.
Wow, those are strong words, irrefutable evidence. Eric, another question along those lines. You said the who. Now, from the who there, you meant the order, the specific order. You cannot, with what with your software, you can't tag who who really was with an institution, a high frequency trading firm. But that's something the regulators can find out, correct?
Well, one would hope. I mean, it's so obvious. My first question was, I don't think FINRA is looking at this, nor the SEC. I don't know. Once again, the regulator should be. I should be the first one pointing this stuff out.
Eric, did you read the Wall Street Journal article from Bradley Hope this weekend about clock synchronization and how the regulators' clocks and the traders' clocks are out of sync? What are your thoughts there?
Well, what did FINRA say? If it was more than a tenth of a second, there would be problems. Are they kidding? It just, when they say things like that, it tells me right away that they're not looking at the data, because nobody would make such a silly remark like that. Yeah, the synchronization, I mean, you can get a cheap device that'll attach to your network and do NTP well within a millisecond. I mean, we've had that for a decade now. So,
you don't think this is an overall issue for the regulator? This shouldn't be an issue then?
No. Of course it isn't. Yeah, it is something you want to clean up and have correct. But you can actually still work out what happened when, just by looking at prices as well. For example, when the price shifts for the first time, when you see that, you can synchronize up and you'll know what the offsets are from the other clocks. But that doesn't happen that often. The clocks are pretty darn good. It's not one of the biggest issues. I mean, it's almost like they want to dance all around these little technical issues without actually getting into the meat of it. And one of the things I keep asking the SEC to do is compare the timestamps between the consolidated and the direct feeds. In fact, I emailed Greg Berman this 1 year ago in July, and he was interested in it, and so much to the point that when they released the SEC website that was showing data from Midas, during that press conference, he actually brought up that study to do with Midas, compare the timestamps between the SIPs and the direct feeds, and he called it that's a gold idea, a play off of Midas. And that was back in October, and this is something that I could code up in an afternoon. Okay, and I offered to my assistants to write the code for them, and they haven't done it yet.
So what do you think is holding the regulator back from finding, obviously, and correcting some of these issues in the market?
I honestly don't know, Dennis. It's beyond incompetence now. Now, it's like they don't want to see it.
Eric, you sound almost like you just sound so frustrated with everything that's going on. I mean, have you tried to write your congressman, or do you have any direct contacts with FINRA regarding these issues, or do they just kind of just turn the other cheek?
Oh yeah, I've talked. I've talked to many people. In fact, with the Senate hearings going on, these guys were all visiting our website. And the SEC, by the way, comes to our website every day. I mean, within an hour of putting something new out, they'll be on it looking at it. So,
is it maybe hard to prove some of these things? Is that maybe the issue
not
there
from
too?
Their issue. No, not in their. Yeah, if you didn't have access to their data, it would be. Statistically, you can prove these things, though. However, they've got more than that. They've got the ability to track down the firms and ask them. And so, the regulator has the ability to do that, and why they're not doing it, I don't know.
What are your thoughts on this CYNK from last week? Here's this example where obviously in 1 month the stock goes from 6 cents to $22. CNBC breaking the story last week saying that the company may not even exist. And this stock goes up to a $6 billion market cap. Do you have any thoughts on this and how this happened?
Well, Seeking Alpha had a story on that the very next day. I mean, with not even 24 hours. So like 18 hours later, they already had a story on it, and they said, look, their filings show they have no assets at all. They have no assets, no hope, no nothing. Now, 15 years ago, you didn't need any of that with the web around. But point is that, the private sector had something out that was clearly saying something is wrong here. And the SEC should be with their Midas tool, and how they talk about how they'll be able to look at market data. It took them a month, and at the urging of of maybe CNBC brought it to their attention. I don't know, but
yeah, it's frustrating, especially if this is like one of the pump and dumps, or even I think it was Levine there over at Bloomberg was actually wrote something over the weekend, was saying that this was a classic short squeeze here too, and he was throwing out and this is obvious just scenarios here right now where it wasn't maybe even a pump and dump, it was just get the shorts type of trade where you lend the security. So I guess like over 74% of the stock was held by one person. And maybe if they lend the security, then, they get the rumors going that this is a big pump and dump, and people will come in and naturally short these stocks thinking that the stock really is worthless. And they were selling it at $2 and $3 and $4 and $5 and $6 as the stock continued to climb. And then all of a sudden you don't loan the stock anymore, make the stock hard to borrow. And then all of a sudden you've got, buy-in compliance, where if you can't get a locate on the stock, your brokerage will physically go in and buy you in. Do you think that could have been one of the cases here where a lot of this, crazy buying that drove the stock up to $22 was all short squeeze and maybe even some buy-ins here, Eric?
Could be, with an hour, if I had the access to what the regulator has, I could tell you within an hour.
So we've got to use the data basically better is what you're saying, the regulator, and maybe it's a matter of resources or something, but they're not using the data to the best of their capabilities.
Well, they have 1,000 times the resources I've got. Let's put that in perspective.
So, okay. Eric, what else is on your radar here right now? If you could fix one thing, because there's a lot of things you tweet about all the time that you think are obviously broken here with the market structure.
Oh, it all comes down to the SIP. It's all about the SIP.
So you're still going to go back to the SIP if you want
the SIP. Well, it's the root of everything. When you have dual pricing of the same asset and one group doesn't realize that it's not priced on the fastest one, that's what leads to all of these games.
Okay, we've had Eric Hunsader on, founder and CEO of Nanex, definitely an expert in outspoken critic of high-frequency trading. Eric, thanks a lot for coming on. It's great to get your perspective on the markets, and we hope to have you on again soon.
Thank you very much, guys.
Thanks, Eric.